this just reminds me, it just gets me. So a stock or an index or the market blows out to the upside, like in December of last year. Nobody buys because it's too overbought and just keeps going. They want to get a better price. And then the market pulls back or the stock pulls back 5 or 10%. And
Potential
then
opportunity might be here.
and then it's like, hey, here's a pullback you want. Everyone's like, no, but like things might get worse, so
We
I'm
got
gonna
this
wait.
news story, so
Yeah.
on and so
It's just
forth.
like you don't want to buy the highs, you don't want to buy the pullbacks.
Well, this is
What
the
are you
vision
waiting
we
for?
talk about. Hello, everyone, and welcome to this week's podcast from January the 12th. We're actually recording this on the 11th, but releasing it on the 12th. So, hope everyone is going to enjoy this as we head into the weekend. We have had a pretty interesting start to the day with CPI data being released, a little hotter than anticipated. And for the most part, the market is sort of just accepting it. It was a little mixed the way the market's seeing it right now. But really nothing too much to write home about in terms of what impact that has provided in term from a technical perspective. I mean, we still look right now with many US equity index charts sitting in columns of X's near all-time highs. So it's going to be another interesting week upcoming for sure. But
Yeah. I would have expected a bit more of a reaction, to be honest, because the market's been on fire for so long, consolidating all at all-time highs. It does seem like we need a catalyst to get to new all-time highs. Like seems like things are pretty priced in at this point, and of course, some of the biggest market moves are come off of some type of surprise. So I was expecting some sort more of a market move based off the result this morning, and I think it could be. I know there's some Fed speakers, and then of course we have earnings later this week. So there is some opportunity for a new catalyst.
yeah, out there somewhere potentially. And it sort of is like you said, it's sort of just hanging around waiting for the next what if or what may be
Yeah.
in terms of what may be that catalyst. But I mean, again, looking at the chart of the S&P 500 right now, still maintaining buy signal, still trading yesterday at an X there at 47.80. A move above 4,800 would match the chart's all-time high and also be a
Mhm.
third consecutive buy signal, but it's kind of been hanging around in that 4,700, 4,800 range for at least a couple of weeks now,
And
this
that's
few
what we were,
weeks.
yeah, and that's what we were really expecting after the huge run that we saw, especially in December. You can see on that chart that we'll put on YouTube, but we're talking about here a massive column of X's, a historically large column of X's. So it makes sense to see some consolidation. Visually, that makes sense. And also, I think conversationally, that makes sense. Nice support at 4,700. That's been identified now.
Well, and we can still include some support from prior resistance at 4,600 as well, but having it closer there at 4,700 definitely builds some confidence for sure. And seeing this consolidation now is a welcome sign, even though we're still kind of seeing this chart sit near the top of the trading band. But like you said, it's still fairly healthy consolidation. And overall, we've seen some of these charts reverse down and again some of that normal sideways, some of that normalization though. Some of the indicators though, we have started to see turnover though.
Yeah.
That's one of the things we were going to spend a little bit of time on.
Yeah, we could do that now. I think there's like two segments of the indicator discussion. One, if you look at the S&P 500 indicators, so those that are less familiar, we're looking at like the individual stocks within the S&P 500, how are they participating? One, the bullish percent, how many S&P 500 stocks are on a buy signal? That's at 78% in X's right now. So that has yet to reverse down. Positive trend, how many stocks in the S&P are in a positive trend? 68%, also in X's. You have the 10-week, that's also in X's. So how many stocks are above their 50-day moving average? That's still at 90%. So the vast majority of the S&P indicators are still in X's. The 10-week is close to reversing down. But if you look at some of the other indicators that are more small cap tilted, value tilted, that's when we've seen some softening.
And one of the ones that, or at least two of them that we saw reverse down on following Friday's action, I believe, was the bullish percent for the S&P small cap, along with the S&P mid
Yeah.
cap 400. And in a way, again, this is healthy because we're starting to see at least some type of exhale out of equities within those spaces. And the levels are still fairly elevated. It's not like we've seen the bottom fall out here, if you will. So we're still looking at like the BP for the S&P small cap 600 sitting at 64%, maybe right around 62% actually. So it's interesting to still say that a majority of stocks within these indices are on point and figure buy signals.
Yeah.
And while we've seen some of the shorter term indicators reverse down, they're still not, racing to some low level to show some level of extreme exhaustion yet, or we haven't seen that.
Yeah, and I know we put that out as a tweet, kind of putting the BP small cap and mid cap together. I think they reversed down like right around their 23 highs, if I'm not mistaken. So we saw the same amount of participation throughout 2023, and this was the level that we saw it back off of from before. Another broader universe like the New York Stock Exchange, we saw a couple of shorter term indicators also reverse down there. You have the high low, which is looking at the percentage of stocks hitting new 52-week highs relative to those hitting new 52-week lows. That reversed down this week after hitting 92%. 92% was the high we saw from July 23 and February 23. So like the bullish percents that you mentioned, you're seeing some signs of, short-term exhaustion in that smaller size segment of the market, which makes sense because that ran a lot harder than the large cap space did at the end of 23. So that makes sense to see these indicators begin to roll over, if you want to say first, not to suggest there will be a second, but this makes sense to see these ones be the first to roll over. Another one is the 10-week for the New York Stock Exchange, how many stocks are above their 50-day moving average. After hitting 84%, this also reversed down over the past week. So both short-term signs of some exhaustion coming into play in that smaller size segment.
Well, and we're seeing some of that short-term exhaustion, but like where we sort of mentioned earlier, these are still fairly elevated levels. I mean, the 10 weeks sitting at 76%, the high low still at 82%. I mean, historically, these are high readings. So there obviously is more potential that we could see more exhale out of them because they're still so high. But again, right now, just looking at a lot of the at least recent market action, it's just sort of seen sideways normalization, which in a way is nice after we saw such a crazy run.
Yeah, absolutely. And I think so many people are just waiting to get in, waiting for a pullback. Never happened. So maybe we actually get a pullback. We actually get some consolidation. And then people start to work their way back into the market. Or we get, again, a catalyst that is justifiable enough that puts people into the market. And
that potential catalyst, is possibly right around the corner with some earnings. I mean, we have earnings starting. There's been a few this week already, but the sort of big day is tomorrow, or actually today, and according to the podcast on Friday, January the 12th, have quite a few banks as well as Delta reporting. I know some of the bank charts that we were looking at earlier. We're presenting some intriguing pictures.
Oh yeah. I'm sure you're pulling up a few now. Like JP Morgan, I think is going to be a big one. I believe they're on Friday. I think that chart's matching all-time highs.
It is
right now. Yeah, Bank of America testing a long-term downtrend line. And then some others, I believe Wells Fargo is pretty extended on the upside near some resistance as well. So this is more anecdotal, but it seems like prices have run up in the financials space. There could be some lofty expectations coming into earnings. So hopefully you see a follow through on the fundamental front, or you could get a pretty sharp pullback.
Potentially, yeah. And some of those charts are really, and that's possibly what you need to really sort of look at right now is just where, especially in the case of JP Morgan, where prior resistance was sitting there at 159. That may cause you to possibly look at a smaller scale chart to find some support closer by. And even looking at like the 1 point per box chart right now for JP Morgan did show it reverse down and pull back a little bit to 169 on that 1 point per box chart, but have some support there at 166, a little bit closer by. So that can be a healthy exercise to do, at least if you're looking at something like a financial stock that's run up here recently, hasn't quite pulled back on its default chart. You can look at the smaller scale, maybe find some more near-term support. Give yourself a little more confidence, if you will.
Yeah. So I think, like David said, banks will be a pretty big story coming out on Friday. I think in summary, the technicals look really strong right now. The only issue is that near-term overbought posture and lack of nearby support. So it's never going to be a perfect all green picture, but for what it stands, the picture looks pretty strong technically right now. I want to mention airlines a bit here. You mentioned that Delta is coming out with earnings. I was looking at that chart. Doesn't look great. Like it's a two attribute stock, very range bound. And I was trying to find another airline that looks great, and there's like one maybe, which I think my dad told me this quote, and then I found it online. Richard Branson is like, if you want to be a millionaire, start with $1 billion and launch a new airline, which just kills me. And I think that could translate to the market of it. I mean, like long-term airline returns, whether you're looking at Delta, United, Alaska, Southwest, you name it, like it's really hard to make money long-term investing in airline stocks.
Well, and I mean, even looking at Delta's chart right now, you could call that one of the more range bound charts
Oh, yeah.
on the platform. You've been within basically $30 and $50 for the past going on almost 3 years now. So it's
if you traded the range and you kind of bought the bottom, sold the tops, sure.
Yeah.
But compared to the rest of the market, there's been a lot
Yeah.
better options for the
There's
past 3
been
years.
better opportunity out there. And I mean, even like we're talking about right now, looking at some of these, especially among the major ones. I mean, Delta is the highest attribute among them, and
Two.
it's a 2.
Yeah.
You know, we actually were discussing earlier trying to even find one that might be a high attribute name, and the only one we found was SkyWest, and we then had to look up where SkyWest operated. So that was something that was
Yeah.
intriguing for us to figure out there for a little bit. But even looking at a lot of these charts right now, I mean, with Delta showing a potential for a buy signal, but still sort of in an overbought posture. Next week, another airline that's reporting is United, which is similarly a low attribute 1 for fiver. You've seen it sort of return to a buy signal, reach its way into overbought territory, not nearly as much as other equities, but
Yeah.
I mean, you've seen some slight improvement out of them, but as we're talking about, the technical picture is just bleak.
Yeah, it's just really not interesting to us right now within the airline space. I think you could get some interesting takeaways for sure on the qualitative front, on the fundamental front about what they have to
Spending
say.
probably.
Yeah, spending, consumer demand. I think that's what the market will certainly care about to hear what they have to say.
And in many cases, especially through last year, I mean, there were a lot of them talking fundamentally that they were breaking records in terms of not reports, but in terms of here's how many people we had travel, here, so on and so forth. It's gonna be hard to potentially see that stand up in 2024. I mean, at least to me, in some ways.
Just because those watermarks were so high for last year.
Watermarks were so high, and it was, again, the conversation of coming off of COVID, coming out of the pandemic, people are finally getting back to normal, if you will. And, I think even the cruise lines you saw have that benefit as well. We've seen them sell off much more to begin the year than we have the airlines. But I think it is interesting to listen to, even though these may not be stocks that you own, you can get a lot of information about potential consumer spending, what trends are, what they think the trends are potential for. And that can be healthy for a lot of reasons to have starting point conversations with your clients, but then it can really help you elsewhere in your decision making.
Yeah. I mean, I think most people care about macro right now more than the micro, but using the micro to understand the macro. So understanding like earnings calls and what that may mean about the macro story, the trend of rates, consumer demand. I think that's the big takeaway. You put a piece in the report, shifting gears a bit here, about Boeing. And I know we weren't planning to talk about this, but I was going to bring it up. Airline manufacturer, of course. So adjacent to the conversation. But looking at that chart, I'd be curious your thoughts, because Boeing's a 3 attribute stock right now. Of course, it's been in the news a lot lately when one of the side blew off its plane. Massive pullback on the chart, just beneath of middle of the trading band now. But I'll be curious because to me, visually, this looks like an expected pullback. If you didn't know the headlines, this looks to me like, yeah, that makes sense.
Oh, this goes back to the old adage of cover up the chart. If you ignore the name, if you ignore the headlines, what is your view on that chart? And I mean, is it a pretty notable pullback? Yes.
Oh, yeah.
I mean, considering the date that we're at, it moves from roughly it peaked at 264 and now we're sitting at 224. So we're $40 down on the chart. But I mean, overall, right back to the middle of the trading band, sort of sitting around prior resistance, just above that.
Yeah,
I mean, a reversal up at 236.
that wasn't like half bad.
That
I think we can say
too
it.
terrible.
That wasn't like half bad technically.
No.
Of course, there are fundamental concerns with the company that have come out. However, speaking pure technicals, you get a reversal up, that does not look half bad to me. 3 attribute stack, so there is some left to be desired on a relative strength basis, but just absolute trend chart picture, cover up the name, forget the headlines. No, not that bad.
Yeah, well, and in the case that there's still quite a few charts out there that are extended in columns of X's right now. And yeah, you may have seen an initial pullback, but there's not many stocks that have seen that much of a pullback, especially not back to the middle of the trading band. I mean, it's interesting to me that we've seen this normalization, which has been healthy and welcome by all means, but we're still seeing those trading bands adjust to that normalization. And in many cases, the middle of the trading band is still fairly low. Well, not fairly low, but lower than current trading. So it's interesting to me that we haven't seen as many stocks pull back to the middle of the trading band, Boeing being one of them. And it's maintained a buy signal, maintained a positive trend, and on a reversal back up. I mean,
Not half bad.
those are technical pictures that I think if you're finding stocks that have a similar pullback, that maybe you're like, yeesh, that doesn't look great. Just maybe leave it on a watch list, take a look at it here in a couple of weeks and see what it may look like.
This just reminds me, it just gets me. So a stock or an index or the market blows out to the upside, like in December of last year. Nobody buys because it's too overbought and just keeps going. They want to get a better price. And then the market pulls back or the stock pulls back 5 or 10%. And then
opportunity might be here.
And then it's like, hey, here's a pullback you want. Everyone's like, no, but like things might get worse. So I'm gonna wait.
News story.
Yeah. It's just like you don't want to buy the highs, you don't want to buy the pullbacks.
Well, this is
What are you
the
waiting
we
for?
talk about so much in terms of just our research, the objectivity of figure charting and relative strength, and sort of trying to remove the emotions as much as possible. And I mean, nobody's perfect at it. I mean, it's something that we talk about and we sort of regurgitate it in the process. But I mean, we obviously know that even ourselves and no one else is perfect at controlling that our own emotions.
I know we struggle with it personally as we're investing our money, our family's money in our accounts. We're like, market's pretty high right now.
Do I wait?
Do I wait? And you look on the platform, it's like, 5.0 fund score or whatever it may be. So yeah, we're totally with you. It's a really hard discipline to follow. It is uncomfortable almost all the time, which maybe tells you that it works over a long period of time. Great investing shouldn't feel the most comfortable.
No.
Yeah. All right, two parting shots from me, and then if you have anything, I'd love to hear it too. So two things. I think in addition to the earnings potential catalyst, either to the upside or for consolidation here, there's some seasonality at play. We haven't talked much about this in the report, and I think we will later in the year as the election, as I'm alluding to, kind of comes up. There are some seasonal trends with election cycles. This is fourth year of a president's term, also an election year. Typically, markets do better than you would expect on the fourth year of president's term. Not the best. So third year, historically across the board, typically a great time for markets. Fourth year of the term, still strong, but not as strong. And I'm going to try to put some color around that for our report tomorrow. And we run some sector things every year that I'm sure we'll be putting out shortly as well. Another note on seasonality. This is as it relates to crude oil. So again, left field comment, but crude seasonality is also a thing. So right now, crude's kind of consolidating, crude oil at the low end of a trading range, big area of support. Around this time, you typically see crude oil kind of start to bottom and then build kind of a nice uptrend into about the fourth quarter where it softens. So that's another element of seasonality that could be a tailwind for crude that might be worth monitoring, especially in light of the inflation report today and the future inflation reports that we'll be getting for the next few months.
Interesting, the presidential piece or sort of the upcoming election year piece. I remember some of that, and that it's interesting to me, just sort of the timing of a lot of it, with the third year being the best. It's like at that point, you've either had time to get things in and get them to work as president, or you haven't. So it seems to be that's the year where it sort of hangs in balance for the market as well as a possible president looking for re-election.
Yeah. And I think a lot of it comes down to, this is anecdotal. It's really hard to prove with data, but the element of uncertainty. Markets don't love uncertainty. I would say they hate uncertainty more than they hate a certain thing. So it's like they hate uncertainty more than it's like, hey, this is bad, but at least the market knows it now. So I think that's the big story with election years. When you get to that kind of midpoint, beginning of the year, there's a lot of uncertainty that starts to arise, what effect it may have. And that's what the market doesn't really care for.
Well, and historically, I think there's been folks that, at least I know in the past, have been, you've looked in, we've tried to put research pieces around, does one party getting elected fare better? Now, there are some subsectors and industries that, yes, they do sometimes benefit, but materially over time,
Yeah.
it's a wash.
Yeah,
Like there's nothing to say that one party being in power over the
Yeah.
4 years is better for the market over time. I mean, some presidents are just better than others. Let's just go with that.
Capital Group has actually a really great chart of that. They'll highlight, red or blue for certain regions of the market when certain parties were in power. And I'd be happy to dig that up for somebody if you want to see it. I don't have it on the video today, but great chart just to kind of illustrate your point.
Well, I think we dropped him with enough
Yeah,
tidbits to last him till
Yeah.
next week.
yeah, for sure.
So again, everyone, we appreciate you joining us as always. If you have any questions, feel free to reach out to the analyst team. Phone number is 804-320-8511. And again, appreciate everyone joining. We'll see everyone next week.